Good morning, ladies and gentlemen. Thank you very much, Prem and Janvi, for those kind words. On behalf of BHFL, Pramerica Asset Managers, and on behalf of Pramerica in the US, I want to thank Prem and Cafe Mutual for this opportunity to participate in this confluence. Every year, in late October, global central bankers meet at a place called Jackson Hole in the state of Wyoming in the United States. So against the backdrop of the Grand Teton Mountains, they meet to step back from what they normally do in terms of their monthly meetings and interest rate decisions, and in terms about their press conferences where they provide forward guidance. They step back to look at what are the broad trends, what has happened to the economic and the political and the policy landscape, what has gone right, what has gone wrong with the policy, and how to look forward. So if those mighty central bankers, whose every word we all hang on to, analyze, if they step back from the day-to-day, run-of-the-mill activity to sit down and then discuss and look at things in a broader perspective, I think this confluence that looks at the trends in the Indian investment landscape, the global investment landscape, global markets, and the global investment management industry, I think this is only very appropriate that we should be doing the same thing. My presentation will look at two themes. One is what have been the trends in the market outlook, what has happened and what is likely to happen, and what does that mean for the mutual fund industry. So first, looking at the market outlook, what has happened and what is likely to happen. So the last 30 years have been a golden era for stocks and bonds in the developed markets. We have had a big bull market in both stocks and bonds. So compared to the long-term returns, the returns in the last 30 years, the inflation-adjusted returns for US stocks, for US bonds, European stocks, European bonds, in the last 30 years have been higher than what they have been over the long term, over the last 100 years. So for example, the returns on US stocks have been about 2% higher over the last 30 years compared to the long term. European stocks about 3% higher over the last 30 years compared to the long-term average. Bonds also, as you can see from the red bars, in the last 30 years, they've been much higher compared to the long-term average. So what has driven these higher returns for stocks and bonds in the last 30 years? What has driven this bond market? This bull market in bonds and stocks has been driven by a confluence of positive economic, business, and policy factors. So looking at the bond markets first. Bond yields have declined very, very sharply, and as we all know, when yields fall, prices rise, and you have capital gains. So bond yields in the developed markets have fallen from double digits, about 10-11% in 1985, to negative right now in Europe and Japan, to under 2% in the United States. So a big decline in the bond yields. And that has led to above average returns for investors in bonds. And What drove these bull market in bonds was falling inflation, interest rate cuts, and central bank buying. In this slide, you will see that inflation has come down from double digits, from 8 to 10% in the US and in Europe, in Japan, in the 1980s, to under 1% right now in the US, to under 0.5% in Europe, and is negative in Japan. And because inflation has fallen, central banks have cut rates from double-digit rates to close to zero, and they've been close to zero for the last 6 or 7 years. Actually, they've now been cut into negative territory, and then they're looking for further rate cuts deeper into negative territory. In addition, there have been central bank buying of bonds, as you can see in the slide at the bottom, that central banks have expanded their balance sheets by buying up bonds to such an extent that there is not much bonds left to be bought. So, falling inflation, interest rate cuts, and central bank buying, these are some of the factors that have driven the bull market in bonds. Next, looking at stocks. Global stock markets have also had a bull market, driven by some of the same factors. So, low interest rates, interest rate cuts, liquidity provided by central banks, and then falling inflation and falling bond yields that has led to PE expansion. So, you have had PE expansion, multiple expansion on the one hand, and on the other hand, GDP growth rates were very strong, so profits rose, so the E went up. So you had the PE going up on one side, the E going up on the other side, and that led to the bull market in stocks for the last 30 years. So as you can see here, GDP growth rates have been higher, but now they have started to decline. And you can see on the far side that you have emerging markets and India, where growth rates are increasing, while growth rates in the developed markets are coming down. So what does this mean? This is history. What does it mean for the future? Well, all good things have to come to an end. So the bull market in stocks and bonds in the developed markets, not the emerging markets, the developed markets, is probably going to come to an end. I'm not saying that we will not have returns, but we will not have the kind of large returns, the big returns that we have had in the past 30 years. Bonds and stocks in the US, Europe, and Japan are not going to give you the same returns to investors that they gave over the last 30 years. So investors in the developed markets globally have to look to make money elsewhere. So why is it that this bull market in stocks and bonds in the developed markets has to come down? Because the factors that drove the bull markets those tailwinds are not there anymore. So for example, inflation in the developed markets came down from double digits to single digits. Not much room for inflation to fall further. In fact, central bankers are trying to push up inflation. The Bank of Japan is trying to push up inflation. Interest rates. Central banks have already cut interest rates in US, Europe, and Japan close to zero. Not much room to cut interest rates. So, in terms about what the central bankers can do, there is not much left for them to do. Bond yields have already fallen close to zero, or not much room for them to fall further. So where are you going to get the capital gains in bonds in the developed markets? GDP growth is also downshifting in the developed economies because productivity is slowing down. And because of aging populations, employment growth is going down. So when you have lower productivity and lower employment gains, that leads to lower GDP growth. So US GDP growth is around 2.5–3%, Japan is struggling with 1% GDP growth. Europe is struggling with 1.5% GDP growth. So when you have that kind of a growth rates, where are you going to have corporate profits? Profits are also coming down. So when you don't have policy support, when you don't have good growth, when you don't have good profits, where are you going to have stock market gains in the developed markets? So developed investors have to look elsewhere. And where are they going to look? Well, if you look at the bond markets, as we said, there is not much room for further decline in bond yields. In fact, bond yields may begin to rise. If the Fed raises rates, the bond yields will probably rise. So at some point, central banks will have to start raising interest rates in the developed economies. Bond yields are probably going to rise, which means that the capital gains won't be there in the bond market. So investors in bonds will have to look for yield outside. They have to look for emerging market debt. They will probably have to look for corporate debt. They have to look for high-yielding debt. Those are the things that investors will be looking for going forward. On the stock side, because the returns in the developed markets are going to be lower, they will have to look for returns, higher returns in emerging markets. They have to look for products that will give them higher return, which will bring us to the trends in the mutual fund industry. But before I get there, I want to talk about the markets. So if the developed stock markets are not going to give you the high returns, investors will have to look for higher, stock investors will have to look for returns in other markets like emerging markets. And what is the outlook for emerging markets? I think that the outlook for emerging markets is very positive because all of the factors that drove the bull market in the developed markets, like falling inflation, interest rate cuts, higher growth rates, all of those factors are now in play in the emerging markets. So that's why we have seen emerging markets like as a whole, and within emerging markets, India have had a big rally. But there is still a lot more room for this game to play out because inflation is still higher in the emerging markets. So inflation has to come down. So India, it's about, we have already brought it down from about 10% to about 6%. Brazil, inflation is already still in double digits. Russia, it's still in double digits. That has to come down. So inflation coming down in the emerging markets, that gives room for the central banks in emerging markets to cut rates. So falling inflation means interest rate cuts by the central bank. That should provide fuel for multiple expansion in the developed economies, in the developed stock markets. Within the emerging markets, India is in a very good place, very good position. I don't need to say that. Just a few days back, a very famous banker, Mr. from JP Morgan, Mr. Diamond, Jamie Dimon was here, and he also said that India is among the emerging markets is one of the bright spots, and there are a lot of prospects for India. So in the case of India, because of favorable demographic factors, good domestic policy, they are able to attract foreign capital. So India has also been able to attract a lot of foreign capital, and that is probably going to continue because of good domestic policy, because of good demographic factors, and all of that should help the Indian stock market to also continue to post good gains. So what we are likely to see over the next couple of years, I'm not talking about the next couple of weeks or months, but over the next couple of years, we should see emerging markets having a very strong gains, which means their share in global market cap is probably going to rise. In fact, studies by some of the big brokerage houses show that the share of emerging markets in global market cap, which is right now about 30% versus 70% for the developed markets, that share will increase for the emerging markets to about 50% over the next 15 to 20 years. And the share of India in global market cap is going to rise because of stronger gains by the Indian equity market. The share of India in global GDP will rise because of stronger growth rates. So, as the developed markets post lower returns, there are increased opportunities for investment returns in the emerging markets and within emerging markets for a market like India. So, given that, what are some of the trends in the global asset management industry? And I'm going to speak here more from the developed markets point of view to show that maybe that is where the Indian mutual fund industry, where the Indian investment landscape is going to have to probably go over the next several years. So one of the things that has happened over the last several years is that the correlation between markets and within markets has increased significantly. So the correlation between developed market, between the countries within the developed markets, that has increased. The correlation between developed markets and emerging markets has increased. The correlation between stocks and bonds, that has increased. What that means is that because you have an increase in correlation, the diversification benefit from owning different assets and all is probably coming down. So because of the decrease in diversification opportunities, then investors will probably have to look for those products that will continue to provide the benefit of diversification. So how do you do that? So what are some of the trends in the asset management industry? The first thing that has happened, especially in the United States, and this is probably a trend that will probably move on to Europe, and perhaps after that into Asia and to the emerging markets, is the growth of ETFs and passive investing. So the passive investments in passive assets and in mutual fund and in ETFs used to be less than 1% of total as AUM. They have gone to almost about over 20%. The AUM in mutual funds and passive mutual funds and ETFs has gone from below 1 billion to almost about 3.5 trillion. On the slide on the other side, you have global ETF growth. And the global ETF industry has grown to almost about 3 trillion. And then Goldman Sachs has done a study where they've analyzed that the ETF industry is going to grow at about, the ETF industry will grow at about 10 to 15% annually and will grow from 3 trillion to about 7 trillion in the next 5 to 10 years. And about 70% of the ETFs are concentrated in the United States, which means that the next phase of growth is probably going to come in Europe and in Asia. So there is probably a big growth in the ETF industry outside the United States and also in the United States. Within the US, there has been a big trend of moving away from active to passive, both on the retail side and the institutional side. So in 2005, the share of passive investing and investing in ETFs was below 20%. Now it's almost gone to close to 40%, both in the case of retail space as well as in the case of institutional space. And this trend is probably going to continue, and in the United States, and then probably move from the US to the other markets. So that other markets like Europe, and then Asia, and emerging markets, and India will have to prepare for this particular trend. So what is the future of the ETFs and passive investing? This trend is likely to continue to grow. As I said, about 70% of the 3 trillion ETFs are all based in the United States. So the penetration of ETFs in Europe and in the Asia region will have to grow. And that has a big scope for ETF growth in a country like India. But even within the United States, there is likely to be a big growth of while the share of the US will come down, the absolute numbers in the US will probably continue to grow, because there is a movement away from active investing with paying high fees to paying lower fee ETFs and passive investing. And then when you have product innovation, things like smart beta, enhanced indexing, all of these product innovations, these are products that will try to overcome the problems of having less diversification across markets. Because diversification has come down, you have to create products that will give you the benefit in enhanced diversification. So a product like smart beta gives you the benefit of diversification when the correlation between markets has increased. So there is a lot of product innovation coming up in the US, and those kinds of product innovations will probably gravitate from the United States to Europe and to the emerging markets. So finally, the trend in the US asset management industry is the growth of ETFs and passive investing, and the growth of high active share strategies. One of the things that we have seen in the US is that many of the active managers have underperformed. So what is probably happening in the US is there's like a barbell strategy. On the one hand, ETFs and passive investing, and on the other hand, you have very high active share, meaning that you're taking very aggressive bets, ex-benchmark bets. So you have a barbell strategy of passive on one hand and high active strategies which will justify the fees. And then the growth of multi-asset, because correlations between markets and assets have increased, you have to have multi-asset products that will enable you to have diversification. And then quant products that will enable you to identify factors and invest. So these are some of the trends that are happening in the US mutual fund industry, and these are the trends that will probably continue to gravitate towards the other markets. So to summarize, the bull market in bonds that we have seen over the last 30 years is probably come to an end. I'm not saying that there is a bear market, but you will not have the kind of above average gains that we saw over the last 30 years. Developed markets will have to get used to lower returns. The same thing with stocks. The stock markets, the developed stock markets will have lower returns. So both bonds and stocks will have to look for opportunities elsewhere. And that's where a market like emerging markets with higher growth rates, with higher yields, and scope for continued bull markets in the emerging market stocks and bonds, those are the places where there are going to be increasing investment opportunities for the developed markets and for investors in the developed markets. So therefore, we should continue to see a continued increase in fund flows into emerging markets, into India, only because of lower returns in the developed stock and bond markets. And then in terms about products, we have seen a big growth of ETFs and passive investing, high active strategies. Now, these may not be very relevant for India because in India, a lot of active managers are still beating their benchmark and then earning their fee. So maybe there is still room for active managers to perform, but in more mature markets, active managers are finding it difficult to beat their benchmarks. So they have to go in for high active strategies. But maybe over the next several years, that is going to be also a trend that will happen in a country like India. So this barbell strategy of passive and ETFs on the one hand and high active strategies, those are the things that are taking place in a country like the United States and in Europe, and that is probably going to spread to the emerging markets. So I think that the outlook for the Indian mutual fund industry is continues to be, I expect will be very strong because of the trends that I've outlined, because there are opportunities for investors outside India to make above average returns in both stocks and bonds in emerging markets, including India.
They don't like to invest overseas. In Indian army in America, what's your advice to give? Should they take some part of their portfolio? They're all advisors here. Would you recommend that they ask their investors to invest a part of their portfolio in foreign securities, foreign mutual funds?
Yes, I would, because as I said, that emerging markets as a whole offer better opportunities. So, and while India does offer, is one of the very strong performing emerging market, and the returns in Indian stocks and bonds are quite good, there are other emerging markets that will probably offer good opportunities. So that Indian investors should probably think about investing in other emerging markets, and also from time to time on an opportunistic basis in the developed markets, because there may be, while the markets as a whole may not do that well, the developed markets, there may be sectors or individual plays that could probably provide those kinds of opportunities. So this, what you mentioned is about the home bias. One of the things is that even in the developed markets, there is to be a big home bias, which means that they would only invest in their own market and less of investing outside. And the trend in the developed markets has been that home bias has come down, and they are looking to invest outside. So I think that in emerging markets, and in India, the home bias is quite big. It's not just patriotism, it's a home bias, not just in India, in all emerging markets. So we should probably see an increase in reduction in the home bias and investing abroad. And investing abroad does not necessarily mean that you're being unpatriotic.
Okay, thank you.